Hello and welcome to this week's US Stock Market Report. I'm Dale Gillham, Chief Analyst to Wealth Within. This week I'll be discussing dividends and dividend reinvestment plans, the Dow Jones and this week's stocks of interest. Before we jump into the report, I'd just like to mention that if you have any thoughts on this week's report, please comment below and be sure to subscribe to our channel to keep up to date. Let's get into this week's report. Over the decades that I've been helping traders and investors, one of the more common questions I get asked is, what do you think about this stock? The reason this question comes up is because more often than not, the individual asking is losing. In response to this question, I always ask, why did you buy it? And the answer is because it pays a good dividend. But is investing for dividends and using dividend reinvestment plans the best strategy to apply in the stock market? I would argue that you shouldn't buy stocks on dividends alone. A good investment must have capital growth whereby your investments appreciate in value and income from dividends. While both are equally important, depending on your circumstances and where you are in your life, you may place more emphasis on one or the other. That said, I teach traders and investors to develop a strategy that combines both using my 4 golden rules to investing in shares, which I outline in detail in my latest book, Accelerate Your Wealth, It's Your Money, Your Choice. So let's take a look at what dividends are and why you would consider using a dividend reinvestment plan in your portfolio. When you purchase shares in a company, you're entitled to receive a portion of the profits in the form of a dividend. How much you get paid will vary widely. Therefore, it pays to check the company's dividend policy before purchasing shares to ensure it fits with the goal of your portfolio. When you purchase shares in a company, you are entitled to receive a portion of the profits in the form of a dividend. How much you get paid will vary widely. Therefore, it pays to check the company's dividend policy before purchasing shares to ensure it fits with the goal of your portfolio. For example, if your goal was to purchase shares that deliver both growth and income, then purchasing a small cap stock may not deliver the outcome you are seeking, as it may not pay a dividend. Companies usually pay dividends twice a year, although depending on the company's policy, they can pay more or less frequently. You can find out when a company pays its dividends by visiting the stock exchange or by going to the company's website. So when are you entitled to a dividend? Each dividend has a record date and an ex-dividend date associated with it. The record date is the date the company closes its register to determine which shareholders are entitled to receive the current dividend, while the ex-dividend date falls 1 business day before the company's record date. To be entitled to a dividend, you must have purchased shares in the company before the ex-dividend date. There is no set formula as to how a company will calculate the percentage of profits they will pay as a dividend, as there are many factors that are taken into account, which is why this is largely irrelevant. What is important to understand is how to calculate the dividend yield you will receive. A company's dividend yield is calculated as the income you receive from holding the shares, expressed as a percentage of its current market price. Therefore, the dividend yield equates to the annual dividend per share divided by the current share price multiplied by 100. For example, if you purchase shares priced at $1 and the company paid a dividend of 10 cents, its dividend yield would be 10 cents divided by $1 multiplied by 100, which equates to 10%. Therefore, when you purchase shares in a company, you secure the price at which the dividend yield is calculated, because your entitlement to a dividend is based on the price you paid for the stock. So what if the price of the stock you own rises to $2 and it still pays a dividend of 10 cents per share? The dividend yield would now represent 5% based on the current stock price. But your dividend yield would continue to be 10% because you purchased the shares at $1. Interestingly, as the price of the stock falls, its dividend yield generally rises and therefore becomes more attractive to investors seeking dividends for income. But some would have you believe that a higher dividend yield means the stock is cheap and an opportunity to achieve good capital growth. Unfortunately, this is only true once the stock stops falling. On the whole, companies that have a history of paying good dividends are profitable. Therefore, I recommend identifying companies that pay a good dividend yield and are falling in value, as they may alert you to stocks that will eventually turn and start to rise once again. So you get both income and capital gain. Many companies also offer dividend reinvestment plans, which allow you to use the money you would normally receive as cash to purchase additional shares in the company. The main advantage of a dividend reinvestment plan is that it compounds your returns because you're reinvesting your earnings. It is also a very effective form of forced savings, provided you know how to protect your capital if the stock turns and starts to fall away. So how does a dividend reinvestment plan work? Well, shares are usually issued at current market prices, although sometimes they are offered at a discount. In most cases, you can nominate whether all or part of your shareholding is included in a dividend reinvestment plan, and the good news if you decide to reinvest your dividends is that the shares are acquired without having to pay any brokerage. Once you receive a dividend payment, the company will issue a statement detailing the allotment of shares you received as part of the dividend reinvestment plan. You should ensure you file this statement with your contract notes so that you have all of the records available when preparing your tax return. Whether or not you reinvest your dividends will depend on your investment goals. For example, if you choose to operate a growth portfolio, it makes sense to reinvest your dividends so that you compound your returns. However, if you are operating a portfolio to generate income, then you would take the dividends as a cash payment. This is more common for retirees who may not necessarily need capital growth and would prefer extra income to support their lifestyle. Interestingly, dividend payments are often more attractive for retirees than receiving rental income from properties, for two reasons. Firstly, because the dividend yield on many stocks is higher than the rental yield on a property. And secondly, when you factor in the cost of maintaining the property, many find the net yield is very low. But what if you would prefer to receive the dividends as income rather than reinvest them? The question is, what should you do with the cash? Now, I strongly recommend you use it to fund other investments. For example, you could take the money and place it in an interest-bearing account to build up a deposit for a home, or use it to pay down your home loan much quicker. Alternatively, you may want to use it to purchase other stocks so as to build up your portfolio. Either way, the important point to remember is whatever you earn from investments must be reinvested into other assets so that you continue to compound your returns. So there you have it, all you need to know about dividends and dividend reinvestment plans. Now, before we get into this week's stocks, I wanted to announce the date for the live online seminar that I'm doing with subscribers to this channel. The session will start at 7 p.m. next Wednesday, the 5th of December. Now, in order to receive your link to attend, you need to be subscribed to the channel and send an email to info@wealthwithin.com.au. In the subject heading, put YouTube, and then in the body of your email, your YouTube name. We will email you a link and instructions on how to get into the live session. Remember, this is not being recorded and it will not be posted on YouTube. Rather, it is a private session with me where I will answer any questions you have, tell you my thoughts on any stock you like, and share with you many trading tips and hints. Now let's get into this week's stocks. Alrighty, on your screen right now is a weekly chart of the Dow Jones Industrial Average, and you can see here how last week, which is the week ending the 23rd of November, we saw it open at 25,392 with a low of 24,268. Closing, and this is the important point, it closed at 24,285, just slightly above its low. It's very slight difference between its low and its close. Now, another interesting thing is this is the lowest close that the Dow has had in several weeks. So if we go back here and we look at we get a little crosshair on it, so you can see where that low is. If we go across here, that's probably the most recent low. That's back in June 2018. So 5 months ago was the lowest close, and it was pretty much the same close as there. It was probably just a tad lower back in May. So interesting thing, the Dow is closing lower than it has in the last 5 months. Now, here's the other interesting point we need to look at is that low of 24122.23. I would expect that would get broken this week. I think the Dow is looking bearish still, and as I've been saying, I still think it needs to go below that 24,000 point mark, probably down to that 22,000 mark, and getting that sort of roughly at 15% fall, roughly sort of 10 to 15%, but I'm more thinking 15. And I did allude that it could go to 20%, but I'm still thinking 15% will probably pull the Dow up. If I make this a monthly chart, you can see the Dow still looks reasonably good, and this is where people who look at daily charts and see this mess, and I will change it to a daily chart in a little while, but you can see here the Dow has been beautifully bullish for the last couple of years, and this current month, if we just do that, it still doesn't look too bad. If you're looking technically, it still looks all right, the Dow, but it does need to readjust back to more sustainable levels, and that's why I don't think it will crash. Looking, here's a weekly chart, looking at the, sorry, not daily chart, I mean, looking at a daily chart, this doesn't look anywhere near as good. You can see here on Friday, it gapped right down from where it closed on Thursday, closed low, so it doesn't look as positive. That's why I'm not really super bearish on the Dow. I am bearish, and while I'm contrary to a lot of people out there in the media talking the Dow's going to crash, big heavy falls, those sorts of things, is the reason why I'm not saying it's going to crash is because I'm not self-interested in the Dow. That's pretty much as simple as it is. I don't make money from you buying or selling stocks or what you think the Dow's going to do. I'm just giving you my honest opinion. Whereas the people putting out the news are wanting you to use their stockbroking services, those sorts of things, to buy and sell so that they make more money. To me, I just think the Dow's going down at the moment. It'll probably go down another 5 to 10%, maybe. It'll go down to the area where my pointer is now, around that 22, maybe $23,000, 23,000 points, and that'll start moving up again. Today I wanted to talk a bit about with the stocks. I actually wanted to talk about the FAANG stocks, because I actually did some stuff over this last week on the FAANG stocks for the media throughout the US. So if you haven't seen some of my stuff, it's on. You can go to Value Walk, US News and Media. I've been writing for them more recently. There's a few other places that I've been writing for, and so looking for some of my analysis on some of these stocks. Now, FAANG stocks have been in the news a little bit more because they've been quite bearish, more so lately. I've just updated the data on Apple there, so you can see here Apple has been very, very bearish this last month, and it's just doing normal things. And a lot of people get scared, and they go, "Oh, I was in FAANG stocks, and I've lost a lot of money." I mean, technology stocks. I mean, the FAANGs are about 10% of the S&P. Technology is around 25% of the S&P. So when these are going down, the S&P is likely to go down, especially if you've got other big stocks like banks moving down with them. Those big stocks will start dragging that. But it's as I said, these are 25% of the S&P 500. But looking at this, Apple just looks a bit bearish at this point in time. But if I use a trend line here, and you can just see going across these lows here, if I just go across here, my guess is it'll just come back to where roughly this line is. So there's a little bit more downside on Apple, and wouldn't be in this stock at this point in time. Actually, there's no FAANG stocks or FAANG stock that I would actually be in. Netflix has been the best of all the FAANG stocks in terms of growth over the last few years, which probably would surprise a lot of people actually, that it has been the best performer. You would think, Apple or Facebook or something else that's more high profile would be the best stock. And I'm just downloading data for Facebook too. For some reason, my data is not there. But you can see here how Facebook is looking quite bearish. It had its high back there in July, and it's still likely to continue to fall. But if I go into a monthly chart, you can again see that it has this beautiful, beautiful trend, this stock does. So if I get my nice little trend line tool out of here, and I just bring it up around there, you can see here it's really coming down to the area where you think it's going to start to find some support relatively soon. And I wouldn't think it's going to be too much more before Facebook finds some support and starts to rise up again. I'd be looking around that $114 odd mark for it to find some support and start to move up again. So let's look at the next one. Google, another fantastic stock, and these FAANG stocks are just readjusting, as I said. So now's the time, if you're not in them, just to sit back and wait for them to find the low that we're expecting, and then for watching them to start moving back up again. But if you look at this, you can see here how that momentum is all these peaks and troughs all around here. So it's getting down to that level where it'll probably drop below this level, a little bit and then find some support. So if I grab this here and I whack up here, you're probably going to see it probably fall down into that sort of 860 and above. It'll fall into that sort of area. It may not fall that far. It might fall between that 1000 and that 860. There'd be a bit more work I would need to do to give you an exact area or target area in time and price for it. I'm just giving you some really high level information at this point in time, but I would think it will drop through this dashed blue line somewhere into this sort of area, find some support, and then it'll be a perfect place for most people to buy it. Netflix, as I said to you before, Netflix has been the actual biggest performer on the Dow, on the FAANG stocks, and it has absolutely flown. And you can see here, looking at this chart, how well. Let me go around there, how well it's actually gone over the years. And if you do an overlay chart where you put all the FAANG stocks on one chart, you can actually see how well this has outperformed the others. But again, just looking at the trend line here, and if I got my little blue dash thing here, you go and put it there across here, and you can see it didn't work, that one. Looking at that, you can see how it ran along that line there, came up and around it. So it's probably just going back to this sort of area here around that 210 to 220 mark. And that's where I think it'd probably find some support at this point in time. But it is, as I said, these big stocks, all these big FAANG stocks are pulling the Dow down. That's why I don't think the Dow's going to truly go as deep as what the media and other people are putting out there. I don't think it's really going to go that deep, because once these stocks find some support and start to move up again, then they'll take the S&P and the Dow back up with them. So Netflix, as I said, these sorts of stocks at this point in time, I wouldn't actually be in them. As I said, I would have used exit strategies, and this one, some of the exit strategies I teach in my beginner's course. My beginner's course would have had you up around that 370, 380 mark. My diploma course, you would have been in it and making really good money. I did some trading on these stocks using the rules that I teach in my book called Accelerate Your Wealth. And again, you would have creamed the profits on these just from getting a $24 book, and because they are good trading stocks. But right now, this one's looking bearish. Last one we need to look at, I think it's the last one, isn't it? Facebook is the last one. Yeah. No, Amazon is the last one. So Facebook, let's just update the data. I thought I'd looked at these before on this computer. I do apologize. Normally I would have had the data downloaded on these. But looking at Facebook, it is looking really, really nice. It has fallen quite heavily, like the other stocks as well. And having going down, its high there was in July. Does look quite bearish at this point in time, but again, I wouldn't expect it to fall too much farther here. So if I go and put on my retracement tool, plonk it on that low there and whack it here, you can see here that my expectation would probably be around about the $118 mark would pull it up. If it falls through that, it'll be 94, but I think it'd probably find some support around this $118 mark. And it's you see these big falls down through here. Volume sort of, hopefully you might see some volume increasing. If you do see some volume increasing on that weekly chart, it'll probably start to confirm that it is having that exhaustion phase to searching for that low. But at this point in time, again, I wouldn't be in Facebook. I'd just be sitting back waiting. And the last one we've got is Amazon. And again, look at that magic stock. Again, falling away, a big high back in September, falling away quite deeply, but it's starting to look at that volumes there. That's what I started talking about. Some of that, when you get to an end of a run, you sometimes with peaks and troughs, the big ends of peaks and troughs, or the big ends of trends, you can see spike volume or volume rising as you get an exhaustion of a downward move, or that euphoric buying to finish an upward move. And this is where it gets down to what stops a trend. And a lot of traders and a lot of investors don't understand why a trend finishes and why price turns the other way. And when you understand what turns trends and what causes trends to stop and start to turn around and move the opposite direction, whether it's bull or bear market trend, you start to understand where is the safer places to enter and exit a trade, and where the best place to take profits from your trade, which is what most traders don't understand. So again, right now at this point in time, Amazon not looking super bullish. It is more bearish, but again, I still would expect it to find some support in the near future, and I would think it would probably find support probably somewhere around about that $1, that 1,350. It could go a little bit further in its move. I'd need to do a bit more price work, but again, Let me put my trend line on here. My little trendliney tool. If I look at that, you're probably looking at, probably around that 1350 mark. Probably touch that bar here, that blue bar here, around about that 1300 point mark. Find some support and start to move up. But again, I wouldn't put an entry at strategy at 1300 or that 1359 if it just stopped there and bounced a little bit. I'd make sure it's going up before I enter into that stock. But again, all FAANG stocks are bearish. All the FAANG stocks, you should not be in it. If you're holding it for this downward move, you're not doing the right thing for your money, because all of them have fallen very, very, very heavily. If you can look at here, again, this has all fallen 30%. If I go back to Facebook, you can see how this has fallen from here down to there, 41%. This is, if you've got stocks that are falling this sort of areas, there's now 40%. You are not doing the right thing as far as being a trader or an investor. You should have exited these stocks, because you could actually make more money by exiting at the right spot and actually coming back in at a lower price and compounding your return. 40%. Most of them are 40%, other than Google, which, as you see, there's 21.83. They're all 40%, 41%, and 30%. So you would think Amazon would probably go down, as I said, down to here probably, and it may go down to that 40% there before it finds some support. But right now, those sorts of ranges means you need to exit those, come back in at lower prices, and you'll make far more money. This is what I teach in my book, Accelerate Your Wealth. It's available in all good bookstores, or online at wealthwithin.us. I'll talk to you next week. Take care. What are your thoughts? If you've got any questions, please comment below. Go and listen to our Talking Wealth podcast. They're available on SoundCloud and on our website. Now, they're jam-packed with valuable information which will help you elevate your trading. Now, if you're serious about learning to trade the share market and you'd like more information about our courses, please click the link in the video description below. Thank you very much for watching this video. If you've liked the video, remember to subscribe to keep up to date. I'm Dale Gillham, the Chief Analyst here at Wealth Within. Goodbye, good luck, and good trading.